Hello, everyone. Welcome to another episode of Dollar Dialogue. Today's episode is episode 58 inside private equity and quant finance in NYC with Araf Malik. Araf Malik used to be the previous main host of Dollar Dialogue, but since his acceptance into Cornell University this academic year, he has uh, he has stepped away from the podcast, and currently me, Supreet, and Chazib are leading the podcast. So it's a pleasure to have Araf back in the podcast. I believe we did over 40 plus episodes together, or 30 plus, and it's a pleasure to have Araf back in the podcast to talk about his experiences at Cornell University as an economics major, and additionally as he steps into private equity and quant finance in New York City. So, Mr. Araf Malik, is there anything else you'd like to add to the introduction that has just been said?
No, thank you. That was a great introduction. So a little bit more about me. I'm Araf Malik. I'm currently a freshman at Cornell University studying econometrics to be specific, and I'm also minoring in data science and business finance. And yeah, so that's a little bit of my academic side. As some of And on the side, I'm also involved in private equity in my home country of Bangladesh, and in some countries, and in a country in the MENA region. And so yeah, that's a little bit about me, and I'm very happy and delighted to be here with you guys today.
Thank you, Mr. Araf Malik, for that introduction. And moving forward, today we'd like to talk about private equity and then move on to quant finance. But firstly, we'll delve into private equity. And although the title suggests equity in NYC, since our office is based in Cornell, which is in New York State, we will also delve into private equity in other parts of the world where they're prevalent as well. So, private equity is often talked about as if it's mysterious or worse, predatory, but economically, it's simpler than the stereotype suggests. At its core, private equity does one thing: it buys companies that are not publicly traded, attempts to increase their value or their valuation, and sells them later at a profit. That's it. The complexity lies in how that value is created and who bears the risk along the way. New York City is one of the global command centers of this industry. From Midtown to Park Avenue offices, where I've personally visited some of them, private equity firms manage trillions of dollars in assets raised from pension funds, university endowments, sovereign wealth funds, and high net worth individuals. These investors aren't looking for quick trades, they're looking for illiquidity premiums, high returns in exchange for locking up capital for years. Private equity operates on a long time horizon, typically 5 to 10 years per investment. Firms acquire companies through buyouts, often using a combination of equity and large amounts of debt, a structure which is known as leveraged buyout. And debt amplifies return if things go well, but it also increases risk if cash flows fall. So, where does value creation come from? In theory, private equity improves efficiency. Firms streamline operations, cut unnecessary costs, professionalize management, and reallocate capital more aggressively than public companies often can. Because private firms don't face quarterly earnings pressure, they can make long term operational changes that public markets may punish in the short run. In practice, therefore, value creation is mixed. Some gain from genuine productivity improvement, better logistic, improved pricing signals, digital transformation. But on the other hand, there's also we can see financial engineering in some way, as there's increasing leverage, optimizing taxes, and selling assets or extracting dividends early. Therefore, private equity is, although initially it sounds simple, there's a lot of multifaceted stuff related to it, and therefore we can see that private equity is not only for wealth creation, but it can also amplify wealth. And what matters though is also incentives, because private equity firms are rewarded based on internal rates of return, not employment stability or long-term resilience after exit. And that shapes decision making, because NYC's role is critical here. It's where capital is pooled, deals are structured, and exit strategies like IPOs, mergers, and secondary sales are designed. And private equity doesn't operate in the shadows; it operates in plain sight, just outside the public markets. And understanding this is essential because its influence reaches far beyond finance. And therefore, with that being said, we can see that private equity, and I'm not sure about this, maybe Supreet or Shazib can elucidated on that. If private equity is taught in the IBDP business management program. As of my knowledge, in economics, we haven't delved into private equity, and this is something that we don't delve into IBDP economics. But in our school finance clubs, we are heavily engaged with stock market, and we're trying to move into private equity. So, with that being said, before the podcast, we had a few questions for Araf since he's majoring in econometrics at Cornell. And this question came from one of our viewers, Mr. Rishan Ali. And his question was, in New York's finance ecosystem, how much of the value created by private equity comes from genuine productivity gains, and how much comes from financial engineering or informational advantage? So, Mr. Araf Malik, if you have any knowledge pertaining how private equity works in New York, pertaining financial engineering or informational advantage, could you elucidate on that, and as well as share your insights into private equity for our viewers listening?
So first of all, I would like to state that private equity is, again, as Ari Malik has mentioned, it's something that operates outside of the public domain. And so, what is the public domain? It's basically anything that operates out of the any company that doesn't operate in the stock markets. And so we have anyone who is involved in any operations of a company that's not listed on the stock market is technically being dealt and it's technically part of the private equity hemisphere. And this is because you have to first understand that private equity, so that what does that mean? So that basically means that if I as an individual were to buy a company today, and that company, it could be as little as it could be as little as a tea shop on the side of the road, or it could be as little as a souvenir shop. That's private equity because I'm buying it, the souvenir shop. It's obviously not listed on the stock market, so I am dealing with private equity. And to answer Mr. Arif Malik's question, in my beliefs, and obviously the data might change, or and it varies obviously by funds, but I think that there are obviously a lot of operational improvements in private equity because there is a lot of operational management, there is a lot of KPI tracking and cost discipline, and obviously there's also a lot of capital reallocation. For example, there's also shifting underperforming assets to higher return uses. And obviously the private equity firms, they have a very they obviously upgrade the governance because they're tighter boards, the incentives are aligned, and there are fewer agency problems. And with private equity, the firms obviously scale up, and there are roll-ups, there's shared services, and there's also a lot of procurement power for the firms. And private equity by itself is very strong in mid-market firms, and it's mostly present in family run or poorly managed companies. And in my opinion, I think that private equity has a genuine productivity gain of around 40 to 50%, and that varies by funds. Now, talking about financial engineering side of private equity, I think the valuation gained is, I think, around 50 to 60% because of the leverage buyouts, which amplify the returns without necessarily improving productivity. But the cash retraction extraction between long-term value is also realized, and buying cheap and selling expensive due to market timing also limits some of the expansions. And the weaker productivity link is when the holding period is short and the debt servicing crowds out investment. Now, talking about quant finance, I think quant finance has a genuine productivity gain of around like 20% because obviously quant finance depends on market efficiency. There is a lot of faster price discovery and narrower bid ask spreads. And there's also a lot of liquidity provision in quant finance, especially during normal market conditions. And the risk distribution, especially during arbitrage, smooths misprices across assets. And for the system level benefit, the markets process information faster than humans can. And for this reason, I believe that private equity increases some real productivity, but much of its return still rides on leverage and timing. And quant finance improves market mechanics, but captures value primarily through informational advantage and not through economic growth. So that's what my opinion is on this question.
Thank you, Mr. Araf Malik, for that very insightful and detailed response. I see that Mr. Supit Nagala and Mr. Shazib Karim, both of your hands are raised. Would you also like to chime in?
Thank you, Shazib, and thank you, Arif, and thank you, Araf Malik. I'll start off by adding in that when people typically hear value creation in finance, they imagine innovation such as better products, better services, or more efficient companies. But in New York City's financial ecosystem, the reality is a lot more complicated, as reiterated by Mr. Araf Malik. So, as he explained, he has talked about how there definitely are genuine productivity gains, especially with better management, streamlined operations, and improved pricing strategies. However, these improvements are usually incremental. And uh, through some research, I've got the exact numbers. Around 20 to 30% of returns tend to come from real operational improvements in New York City, and this contributes to the value creation. However, a much larger share of returns comes from financial engineering because New York, it has immense access to deep credit markets, and this makes heavy leverage possible. And it's also possible for to magnify returns through debt and lower the tax bills. And all of this allows investors to extract cash early through dividend recapitalizations. And on paper, yes, it does appear as if value is created, but much of it comes from restructuring balance sheets rather than improving what the company actually produces. And then there's also timing and information because being based in New York means proximity to banks, advisors, and capital flows. And firms often buy when markets are weak and sell when valuations are high. And that value is often captured and not really created. In addition, just like how Ari exemplified, quant finance has pushed this even further because in New York, some of the most profitable firms don't focus on companies at all and they just focus on data. Their advantage is product isn't productivity in the real economy, but speed, models, and information. Profits typically come from exploiting uh, no, no. Profits currently are coming from exploiting tiny inefficiencies and not by really making markets more productive. So, uh, when we actually look at the percentages, around 35 to 45% actually comes from financial engineering, 20 to 25% from timing and valuation effects, and 10 to 15% comes from informational advantages. So when you add it all up, only a minority of the value creation happening in New York finance comes from genuine productivity gains. Most of it comes from everything else, from structure to information. And uh, since Ari had asked a question regarding whether this topic was covered in business management IB, yes, it is. It's definitely covered under Unit 3 of Finance and Accounts. Thank you for the amazing question, Arib, and a beautiful response, Araf.
Before we move on further, I think it's very important to define what Supreet means by productivity gains. Supreet, can you please explain what you mean by productivity gain?
Yeah, of course. Why? Okay. So since we actually just started learning this in business management, productivity gains are increases in the economic output produced without a proportional increase in inputs. So that's like it's also sort of related to economies of scale because you are able to get more value out of the same resources, and productivity gains occur when a firm is more efficient in maximizing the limited resources to produce more outputs. And uh, when a firm is more productive, it is able to produce more goods and services with the same labor, capital, or materials, and can or could also produce the same output at a lower cost. Both of this is an exam are examples of productivity increases.
So, Suprit, you have said that it's about increasing output, but
Correct.
increasing output, right? It can also what about the amount of money that's being made? Why isn't that being considered output? Because at the end of the day, are you considering output to be physical goods, services, or what about the profits that the companies are making? They're actually making profits, so why isn't it considered output, Suprit?
Okay, so that is definitely a very good question, and this is completely reasonable. And I'll first give you my short answer. My short answer is because money is money is a measurement of the distribution of value, but not exactly the creation of value. Because in a more clear way, why profits aren't the same as productivity gains? Well, it's because profits tell us who's getting paid and not exactly how much value is created in the economy. However, productivity is about the real output, which is goods and services. Money is about claims on that output. So, if a firm can increase profits in many ways that don't involve producing more or better goods at all, and this is why increasing profits doesn't necessarily mean an increase in productivity gains. I'll give you an example. For instance, let's say a New York company or equity firm buys another company using debt and interest rates. Using debt and interest rates fall, then that's when profits can rise dramatically. However, it's important to note that nothing new was produced, no efficiency improved, no innovation occurred. Thus, profits increased because financing got cheaper. That's a financial gain, not a productivity gain, because there's no difference in the output or the value created for society. So I think that's what I've learned so far. And feel free to correct me because you're obviously going to one of the top Ivy Leagues and you scored a very high on your IB exams, and you're also a role model to many.
Thank you, Supreet. I appreciate the response, and I appreciate your high recommendation of my achievements. And I agree that it's a very contentious topic, and it's very hard to define what is meant by economic output. And economic output, I believe, the conventional definition is that the production of goods and services. But at the end of the day, these companies are indeed making money, and I think there are obviously productivity gains because these companies are providing livelihood to a lot of people. And what this company, especially when I'm talking about quant finance, they're doing is basically making money of the stock market. So obviously, that's not a new profession that has been around in making money of the stock market, making money of the equities market that has been around in the world for a long time. And what the firms in private equity they're doing, is it relatively new? Yeah. But the essence of it is that buying companies and fixing them up and then selling them. It's not the way they're doing it by depth. I think obviously it's increasing productivity in a way as these companies are becoming more efficient in a sense, because obviously someone is buying them and they're buying them for a higher price that this private equity firms bought them for, right? And so obviously someone who's buying them, obviously they are not going to buy a company that's not efficient and some not a company that's not solid. So I think obviously the private equity firms are trying to improve productivity, in my opinion.
Thank you, everyone, for the insightful response. I see that Mr. Shazib Karim, your hand is raised. Would you also like to chime in? Hello, hello, Mr. Shazib Karim. Are you unable to hear us? Apologies, viewers. It seems like Mr. Shazib Karim is currently facing internet difficulties, which is happening quite recently in Bangladesh due to power outrages. Therefore, we apologize for that inconvenience. However, moving on to delve into quant finance, and quant finance, as the name suggests, quant as in quantitative, it is where math replaces intuition. So, if private equity, as Araf and Supreet have talked about, has reshaped companies, quant finance essentially reshaped markets. Quantitative finance or quant finance is the part of Wall Street where decisions are driven less by instinct and more by data, statistics, and code. In New York City, quant desks now sit at the core of hedge funds, investment banks, and proprietary trading firms. In many cases, algorithms execute trade faster than any human possibly could, measured in milliseconds, sometimes microseconds. And this shift doesn't happen overnight. As computing power increased and financial data became cheaper and more abundant, markets turned into data problems. Prices, volumes, correlation, volatility, everything became measurable, modelable, and testable. And the competitive edge moved away from those who had the best intuition and toward who had the best model. Today, quant strategies account for a large and growing share of daily trading volume in US equity markets, with estimates over often placing algorithmic and high frequency trading at over 60% of total volume. And New York remains central because it combines capital, talent, exchanges, and infrastructure, all which are critical for speed driven strategies. So, what do quants actually do? At their core, firms search for statistical patterns, small, repeatable inefficiencies in prices, and these could momentum effects, mean reversion, arbitrage across related assets, or signals in hidden data sets. The profits per trade are often tiny, but scale and speed make them meaningful. From an economic perspective, quant finance claims to improve market efficiency. And by exploiting mispricings quickly, algorithms push prices closer to their true values, and liquidity increases as a result of it. Bid ask spread shrinks, and transaction costs fall. In theory, everyone benefits, but efficiency always has a trade off, as we have learned in our IBDP economics course. As more firms use similar data and model, strategies become correlated. Therefore, when markets are calm, this works smoothly. But during periods of stress, it can amplify volatility. And models respond to the same signals at the same time, creating rapid sell offs or liquidity withdrawals. Events like the 2010 flash crash revealed how speed and automation can turn small shocks into systemic events. There's also a distributional angle. Quant finance rewards mathematical skill, data access, and technological infrastructure, which are all highly concentrated, and returns flow disproportionately to firms that can afford elite talent, proprietary data, and cutting edge hardware. Therefore, this raises questions about who benefits from increasing automated markets. And unlike private equity, quant finance operates almost entirely in public markets, meaning its effects are immediate and widespread. Therefore, price swings affect pensions, retail investors, and global capital flows in real time. So, therefore, what's striking to me is that quant finance doesn't eliminate human judgment; it just relocates it. Human design the models, choose the assumption, and choose when to intervene. The risk is not the machines that replace people, but that complex systems became harder to understand, regulate, and control. In New York, quant finance represents a frontier of modern capitalism, capital guided by math, moving at machine speed. The question is, therefore, isn't whether quant finance will keep growing. It definitely will, as the world is becoming more and automated. But rather, what is more striking, and the question that is more pertinent, is whether markets shaped by algorithm are becoming more stable and efficient, or faster, more agile, and harder to govern. And therefore, at that tension sits at the heart of today's financial system and quant finance. And regarding quant finance, I had a question, and this question came from another one of our guests, another one of our previous guest speakers, Mr. Hamdan Kareem, that he asked before the episode in one of our polls, and he said, and he was asking this to our guest speaker, Mr. Araf Malik, how to break into quant finance, and this was Mr. Hamdan Kareem's question, and this is a question that many people are also wondering. For those who are going into economics, what are the advantages and disadvantages of going into quant finance, and which market is harder to break into? Is it quant finance or private equity?
So I think, in my opinion, and that's the conventional opinion around the world, I think quant finance is obviously harder to break into than private equity, because at the end of the day, what you're doing with quant finance is like you're solving inefficiencies of the market, which in other words is very hard to solve, and you're not solving it, you're trying to exploit it. And so you need strong math skills, you need strong skills in CS, you need strong skills uh, in in problem solving. And so obviously you need usually most people in quant finance, they usually a CS major or a math major. And to give some perspective, when you're a math major, you have to also choose a concentration. So most people in quant finance usually choose a econ concentration, and usually they go in quant finance. And getting a job in quant finance is obviously very hard. Like people are getting paid $500,000 per year plus bonuses, and obviously someone getting paid that much, obviously they need to be very good at solving skills, and very good at solving problems. One thing about quant finance though is that a lot of people try to break into quant finance from after graduating from undergrad, but I think, in my opinion, it's harder to break into that if you're just undergrad. Most people in quant finance, they have a PhD in physics, or in math, or something very quantitative. And so usually physics and math, and so it's a very hard field to break into. And for private equity, it's much easier to contemplate and to break into, is because private equity by itself is it's about finding companies, it's about raising money, it's about leveraging debt. So private equity by itself, it's you don't need much quantitative skills. However, you need like the people side, you need to learn how to talk to people, you need to learn how to raise money, you need to learn how to draw models and have skills. And so quant finance is much harder to get into private equity, but private equity by itself, it's also a very lucrative field, because in private equity you obviously need people skill, you also need math skills, you also need to have a good eye judgment for companies, like what companies you're going to be investing in and what industries you're going to be investing in. So that's my the 2 cents about quant finance and private equity, and I can pass on the mic to Supreet Nagala.
That makes so much more sense, Mr. Malik. Thank you so much for your knowledgeable additions. But me personally, currently, I don't have anything else to add, so I'll pass on the mic again back to Arif.
Yeah, so I personally agree with Araf on quant finance as well, that the market is harder to break into. And this is a question which Araf is, and the comment that Araf made was that breaking into quant finance from undergrad is a bit difficult, as it means that you lack the experience, and since quant finance is so concentrated in math, you probably need graduate school and effectively a PhD to some extent in order to break into. And therefore, the question that arises from this is, what are the trade-offs of doing private equity rather than quant finance? Is private equity worthwhile than quant finance? Because although private equity and quant finance are not in the same market, they do have similarities. So, Mr. Araf Malik, do you think for students and for undergraduates graduating from universities around the world, which market, private equity or quant finance, would you say is worthwhile for those who are concentrated only in economics?
So personally speaking, I'm not a I obviously respect and I respect the individuals in quant finance. I believe that the work they're doing is incredible. Like it's very hard. The work they're doing, they have incredible problem solving skills. They have incredible math skills. They have incredible and skills in general knowledge itself. And I think that whatever skills they have in quant finance, they can easily apply to other fields as well, whether it's physics, whether it's science, whether it's in the field of medicine. So but personally speaking, I am more passionate about private equity myself. This is because I'm a not I enjoy math, I enjoy doing math, but I also enjoy reading financial statements, learning about companies. And quant finance by itself, it doesn't necessarily, it's something that exists mostly in the developed world. I'm obviously a Bangladeshi, and obviously my experiences growing up, obviously I didn't have many interactions with the stock market itself, so I'm more passionate about the equity market. And so obviously private equity is one of them. And for undergrads in econ, I think econ is one of the majors that opens a lot of doors. And obviously there are a lot of people who don't like econ, and who don't necessarily not like econ, but who necessarily talk negative things about econ majors itself. But in my opinion, econ opens a lot of doors, because you're learning about skill, you're learning basically how the world works, and you're learning how the economy works. And that's a very important skill to have. Like I'm a person who wants to have a positive impact on the world, and I to have a positive impact on the world, I need to know how the world works, and I need to know how the economic systems are set up, what institution does what, how debt is raised, how the government works, how firms work, how microeconomic structure works, how international economic works, how global economic works. And so for this reason, if you're passionate about economics, you're passionate about studying micro firms, microstructures, microeconomics, I would say go private equity. But if you are a guy who likes math, who likes problem solving, go into quant. Quant, obviously, in this video, quant and private equity are put together, but quant and private equity are very different from each other in terms of the people who work in it. Because most people who work in quant finance, they are usually people who could easily have like use their skills to work in physics, to work in other science areas as well. So private equity, most of the people who work in private equity, they're usually people who used to work at an investment bank before, in Goldman Sachs or Bank of America or other of the big bulge banks. They were former investment bankers and now they work in private equity, or people who did grad school or masters and they usually go into private equity. But I think the skill sets for private equity and quant finance are vastly different in some manner. And but from my opinion, if you're studying econ, private equity is a way to go, because usually, and it's private equity by itself is also very hard to get into, by the way. So that's my opinion.
Thank you, Mr. Araf Malik, for that very insightful response. So, moving on to the next segment, which is about capital power and the real economy. What we are based on our discussion, what yes, Mr. Supri Nagala. Before we proceed to the next segment, do you have anything else you'd like to add or ask?
Yeah, of course. Mr. Araf Malik was talking about like universities and course selections and all of that. However, I was thinking about the trade-offs of actually doing private equity rather than quant finance in terms of and as an investment option for those big corporations in New York. So when capital is used in New York finance, it can go in very different directions. Two of the most powerful are private equity and quantitative finance. Both can be extremely profitable, but they both come with very different trade-offs. Because, for instance, private equity ties the capital to the real economy. Let's say a New York private equity firm bought a hospital chain or a logistics company. Its returns depend on what happens inside that business. This would require good management decisions and operational improvements. And if the firm does improve productivity and expand services, then real economic value can be created. The trade off is risk and impact, because you see, private equity is a more long term and highly concentrated investment option. A few decisions in a New York boardroom can determine whether thousands of workers keep their jobs, and financial engineering can boost returns. However, excessive debt can weaken these companies and communities. And with quant finance, we have a completely opposite option, because the capital is deployed in markets and not directly in companies. So a quant firm in New York can generate profits without ever touching a factory, a worker, or a product. And the advantage here is the efficiency and scalability, because you see, algorithms can obviously process information faster than humans, and when there's liquidity, when you add liquidity to markets and reduce transaction costs, it's everything is contributes to the advantages. And the trade-off to quant finance is mostly zero sum, because all the profits come from speed, data, and informational advantages rather than real economic improvement. And if a quant strategy stops working, the losses are financial and not operational, but the broader economy usually still looks the same. So, uh, yeah, that's really it on my end, and I apologize for disrupting all of you.
Thank you for the insightful response, Mr. Supriya Nagal. I had no worries about the disruption. The insight that you made are really useful and pertinent to the discussion. So moving forward to the next segment, which is about capital power and the real economy. Private equity and quant finance may look like the opposites, but economically they are two expressions of the same underlying force, which is the concentration and acceleration of capital. Private equity concentrates control. Quant finance accelerates execution, and together they shape how value is allocated and who gets to decide. So, firstly, let's talk about power. Private equity exercises power through ownership. When a firm acquires a company, it gains direct control over strategy, labor decisions, capital allocation, and timelines. Decisions once debated in public markets are now made in boardrooms, often far from public scrutiny. And that concentration allows for decisive action, but it also narrows accountability. Quant finance exercises power differently. It doesn't control companies, it influences prices. Algorithms determine liquidity, volatility, and short term market direction. In moments of stress, they can pull liquidity instantly, amplify price movements, and these can also power. And we can see that power isn't about ownership. In quant finance, it's more about market impact. And both systems reshape incentives in the real economy. Private equity pushes firms towards cash flow optimization and exit readiness. Quant finance pushes market towards speed, correlation, and short term signals. One compresses corporate time horizons into 5 year exit windows, and the other compresses market decision making into milliseconds. And the result is a financial system that increasingly prioritizes extractability over durability. And this has distributional consequences as well. Returns from private equity and quant strategies accrue disproportionately to a small group of investors, and like pension funds, endowments, and there's also risk, while risking risk dispersion. Workers face job insecurity during restructurings in private equity, and retail investors experience volatility driven by automatic trading. And communities absorb the fallout when firms fail or market cease. From an economic perspective, this raises a critical question, which is that are modern finance optimizing for efficiency or speed and control? New York City matters here because it acts as the coordinating hub. Talent flows into the city, capital is structured here, and regulatory boundaries are navigated here. Decisions made in Manhattan ripple outward, affecting employment in the Midwest, factories abroad, and pension returns globally. And this is why finance can be treated as self-contained sector. It's the organizing force for broader economy. How is capital deployed determines which firms survive, which industries grow, and which risks are tolerated. And the deeper tension isn't between private equity and quant finance; it's between financial innovation and economic resilience. Because the truth is, efficiency gains are real, liquidity improvements are real, operational turnouts are real, but so are fragility, opacity, and concentration of power. And that brings us to the question that hangs over modern finance, which is when capital moves faster than regulation, faster than accountability, and faster than real economy, who actually is in control? And that's not a question for traders alone. It's a question for policymakers, workers, investors, and anyone whose future depends on how the money moves. So, with that being said, and this is a question that I would like to ask Mr. Araf Malik, since he's very knowledgeable about quant finance and private equity. Based on what I've said so far, private equity and quant finance basically are in one way or another pretty much the same as the private equity and finance. Although they look opposite economically, they're still constant. They're still following the same force, as private equity concentrates control and quant finance accelerates execution. Therefore, Mr. Arif Malik, do you think quant finance and private equity are they both the same side of the are they both opposite sides of the same coin?
I think in some way, yeah, because quant finance, I think a lot of quant finance firms they obviously try to raise money to operate in the markets themselves. Private equity firms do that as well. So in that sense, they are because obviously quant finance sometimes they raise money from what I believe they do is they raise money from retirement funds. If correct me if I'm mistaken, as well as private equity. So obviously, if that goes wrong, a lot of things can go wrong, right? So if they lose money, a lot of people might lose a significant portion of their livelihood, which is very unfortunate. But obviously, private equity and quant finance are different in a way because I believe that quant finance as the greatest quant finance person of all time, I believe in my opinion is Jim Simons. And from what I understand is that a lot of people who work in quant finance are very smart people, and I think they know what they're doing. So I believe they can be also trusted. It's same as private equity. I think a lot of people who work in private equity are very smart, but private equity obviously has a risk. Some companies may fail, and the quant finance obviously has a risk. You're basically trading, right? But I think quant finance it's models, and so these models are tested. You can't really test in private equity. You can't just buy a company and see if it works or not, because if it fails, you lose a lot of money. And quant finance, if you fail, you lose a little bit of money, but you learn from it and you don't operate a tactic again. But in private equity, you usually would have invested a lot of money in it, and if it fails, you lose a lot of money. So I think in that way they're different.
Thank you, Mr. Araf Malik. I see that Mr. Shazar Karim, his hand is raised. Would you like to chime in?
He's not here.
Apologies, viewers. It seems that Mr. Shahzad Karim is currently facing internet difficulties. So moving on to the last segment for today's podcast, and this is a bit unconventional. But before we wrap up today's podcast, the last segment is pertaining follow up lessons and advice for high schoolers listening to the podcast. So this is the first time in Dollar Dialogue's history that we have had an uh, an undergraduate at or anyone at university come to our podcast and delve into finance and economics. So it's a privilege to have Araf today here. So, and these are some of the questions that some of our guest speakers have left some of the previous guest speakers and some of the audience in the polls have asked to to ask you, Araf, today in the podcast. And this one and this question comes from Mr. Mr. Tarish Ali, and this is pertaining. And this question that he asked was, which skills matter the most at the undergraduate level in college? Finance, theory, coding, math, or real world intuition?
So for the skills itself, and I'm obviously a little biased. So coding skills, obviously you need it, but coding skills obviously you need it when you're operating in the world, because obviously you need coding skills to learn. I think coding skills are important. But if you are like me, I want to operate in the business sphere. So I want to I want to make a positive impact in the world, and I want to run businesses and do those sort of thing. For me, coding by itself is not important, but what I would say, and that's why I'm minoring in a data science, is data science. I think is one of the skills that you should try to learn in college, because to be 100% honest, I wouldn't be a good CS student, because CS itself is one of the most hardest majors out there. So a lot of people can't do CS because it's very hard. I myself, I wouldn't be able to do CS. It's a very hard major. And I think people who do CS, what is CS? It's about learning how a computer functions. It's learning how code's written and how apps are built. But if you're a person who wants to work in private equity or do run businesses, you don't need to know how an app is built. You can usually hire someone to do that. And even if you're starting out, you can usually find people to build an app. And as I'm from Bangladesh, obviously we are involved in a lot of manual production of goods and services. Remember, production of goods and services, not manual, but production of goods and services. So we don't necessarily need an app. We're selling products, right, and services. And so but what we need is data science skills, like how using data to know what's going on. And I think that's very relevant in private equity. I think finance skills, not finance, I think financial accounting, I think that's what's very important. Finance, like you mean, like you're learning about bonds and those sort of things, those are important. But unless you are actuarian, or if you are studying actuarian sciences or something like that, finance skills, you need it. But I would suggest studying financial accounting, which is about the financial statements, and how to read them, how to write them, and how to understand what's written in them. And so I think those skills are very important. And another skill, and that's one of the another underrated skill, is writing. Like, I think one of the skills that you need to know and develop in college is writing. And so for Cornell, we have to take writing seminars, and I think that's one of the best things about Cornell. They make you take writing seminars so you know how to write, because that's one of the most underrated skill out there. If you don't know how to write, I think that's obviously an issue, because writing reports, because when you write a good report, you know to read a good report. If you run a company, or if you're working in a company, it's important that you have good reports to understand what's going on in the company. So I think writing is one of the most underrated skills out there. So I think those are the skills that you need to develop.
Thank you, Mr. Araf Malik, for that very insightful response. Mr. Supreet Nagala, do you have any question that you'd like to ask Mr. Araf Malik as a high schooler who is currently involved, who wants to go into university and also major in business economics and in that sector?
Yeah, I was also wondering about for the majority of the people who want a job after this sector, I was wondering how easy it is to find jobs after just an undergraduate, or whether you suggest we also complete our master's degree.
So I believe, in my opinion, it depends on your major. But I would suggest getting a master's, because I think a lot of people say that, right now in the world you'll see a lot of people saying that, oh, you don't need a college degree to succeed, and I don't think that's true. Yeah, for every person who you see online, for every person who you read about online in Wikipedia who didn't go to college, there are probably 100 people who didn't go to college and like regret it later, because I think college is one of the most important things in life. It's just 4 years. Undergrad is 4 years, masters is 2 years, 6 years. That's not a lot of time, and you're learning a lot when you're there. You're meeting a lot of people. You're learning a lot. You are developing yourself, learning a lot of skills. So I think that if you want to get a job, I think you should get a master's as well when you're there, and you should also do undergrad. Try to do undergrad, then get a master's. I think obviously people say masters might be overrated, but I think like if you look at companies themselves, a company obviously they are going to hire people who have work experience, but I would say that if you are able to find a job after undergrad, do a job for 2 years, then go and get a master's. And usually, and your company might be the one who wants you to get a master's, or you could just make a deal with the company that I want to get a master's, but I also want to work for the company after I come back. Because getting a master's, I think, is a very important skill. It looks good on your resume, and I think it's a very important skill to have. Getting a master's. I myself want to get a master's. My parents want me to do a PhD, but I'm not sure about that. That's a long term commitment, but I think masters is something that you should get. When I was in high school, I thought that undergrad that's it for me, but I think masters is one of the skills, things that I need to do to be able to succeed in life. That's only 2 years. Allocating 2 years of your time and doing a masters, I think that's not a waste. That's a very important investment.
Thank you, Mr. Araf Malik, for that very insightful response. And to wrap up our today's podcast episode, which was about private equity versus quant finance, we talked about a multitude of things. We delved into what private equity and quant finance is. We explored what private equity actually does beyond the stereotypes, how value is created in the financial markets, extracted and sometimes destroyed, the rise of quant finance, and why Mac now rivals intuition on Wall Street, how technology, data, and capital intersect in modern finance. And lastly, we also talked with Araf regarding how high schoolers might approach their university life in regards to business, finance, and economics. So, before we conclude the podcast for today, Mr. Araf Malik, is there anything else that you'd like to say before we depart?
One thing I would like to say before we depart is that study hard, and I think studying, getting into a good uni is, a lot of people might say it's not important, but in my opinion, I think it's kind of important. It opens a lot of doors for you in life, and investing in. I think one of the things that I learned earlier on is that when you invest a lot as a when you invest a lot in yourself in high school, I think it opens a lot of doors for you later on in life. I think the first 30 years of your life, if you work hard, and I think the Palantir CEO, he said it well. If you have a social, if you want a social life when you're like, if you want to be successful, you can't have a social life in your early years, and some people choose to have a social life, and I think it's up to different people. For me, I think I would rather be working hard, and even if I'm not successful, even if I'm not where I want to be, I would not regret it, because I would know that I tried, I couldn't achieve what I wanted. It's fine. So I think that work hard and your dreams will come true. And if you reach for the stars, if you reach for the sun, if you even if you don't reach the sun, you'll reach the stars. So that's what I want to say before I depart for today. Thank you for having me here.
Thank you, Araf Malik, for that very inspiring and motivating way to end the podcast. So I don't think anything else of value can be said after Araf's quote here. So viewers listening here, thank you for watching today's episode, which was episode 58, pertaining private inside private equity and quant finance in NYC with Mr. Araf Malik, who is currently freshman at Cornell and a rising sophomore. So thank you, viewers, for watching, and see you next time with another very interesting episode with another very interesting guest speaker. Goodbye for now.